Coming up on the show today, South Africa's National Treasury says no extra money available for the next 3 years. Angola unveils 2020 to 2025 energy roadmap to reverse oil output decline. And Kenya Airways losses deepen, expects more challenges ahead. Hello and welcome to Business Incorporated. I am Bisi Adebayo. Well, let's get the show started with the markets right away. And major markets here in Africa posted marginal declines at intraday. South Africa's GSE was down 0.07%, while the NSE here in Nigeria was down 0.03%. Egypt closed for the week positive on Thursday by 0.08%. Kenya also ended Thursday's session positive. And major bourses in the Middle East ended the week low on Thursday, and that was driven down by losses in financial shares, with Dubai shares falling the most, although the Abu Dhabi index bucks the trend. Dubai's main share index dropped 0.86%, dragged down by a 2.2% fall in Emirates NBD Bank, while the Abu Dhabi index edged up 0.12%, and that was helped by a 0.5% rise in the country's largest lender, First Abu Dhabi Bank. Elsewhere in the region, though, Saudi Arabia's benchmark index was down 0.26%, while the Qatari index eased 0.16%, hurt by a 1.5% fall in petrochemical firm Industries Qatar. Let's turn now to Europe, where stocks fell in early trade today as investors digested a major policy shift by the U.S. Federal Reserve and reports that Japanese Prime Minister Shinzo Abe is set to resign. Let's talk to Chelsea Delany at the Frankfurt Stock Exchange for more. Good afternoon, Chelsea. So it's a shock to the global markets. The Japanese Prime Minister Shinzo Abe says that he is stepping down due to health problems. What's the financial world saying about his resignation?
Well, it's a surprise. Shinzo Abe has been sick over the past couple of weeks. We've seen reports of him coming in and out of hospitals, but it still was not expected, this resignation today. And we did see that reflected in the market. So the Nikkei, the Japanese stock benchmark, fell over 2% at one point. It came back a little bit throughout the day, but it was definitely a good chunk lower. And we also saw the currency markets react. So investors definitely reacting and responding to this news. And it also comes at a really bad time for Japan. The economy in Japan is contracting at a record rate. The budget deficit is blowing up. They've had to issue a lot more debt. So their financial situation and their economic situation are both becoming increasingly stressed. So to lose what has been the longest serving prime minister for the country, who's been quite a steady hand over the economy, that's definitely a blow right now. There's a lot of talk today about who his successor could be and what that would mean for policy in Japan. Prime Minister Abe was known for his economic policy. He even named after himself Abenomics, and that really was quite revolutionary. The basis of this was extremely aggressive monetary policy, extremely aggressive fiscal spending. It didn't really do what he had hoped it would. It didn't get Japan out of this deflation that it's been struggling with for the past couple of decades, but it did have some mixed successes. So the question now for investors, for economists, is really who succeeds him and whether they will continue this extremely aggressive stimulus policies of the Abe administration. Most economists that I've spoken with do believe that his successor will continue with stimulus for now. The economy is obviously in really dire straits. They need to be continuing with loose monetary policy throughout this crisis, but in the longer term, Japan is facing an increasingly large amount of debt, increasingly strained budgets, so there might have to be changes in the long term.
All right, Chelsea, let's talk about a new data released today showing confidence among German consumers fell significantly in August. Tell us what is driving the darker mood.
So there are a couple different reasons behind this. This consumer confidence survey showed a pretty steep decline in confidence in August. So it had been at minus 0.2% the month before. It fell to minus 1.2 in this month. So one of the reasons for this is that there is a rising caseload in Germany for the number of coronavirus infections. We've seen the number of new infections rise above 1,000 into the highest level since April. Over the past couple of days, there are new restrictions being put in place throughout Germany to help contain the spread of the virus. But it's clear that we are seeing a resurgence in the coronavirus in Germany, and that has really made a lot of consumers concerned. So many people now are concerned about their own incomes. They're concerned again about the state of the economy, and that will likely make them a little more hesitant to go out and spend. So people may not be as willing to spend at stores, at restaurants, things like that, and that could add more pressure onto this economy that's already been reeling.
Amazon has ordered nearly 2,000 electric delivery vans from Mercedes-Benz, and that is the largest ever order for the German automaker. How close is Amazon to making its delivery fleet climate neutral?
So Amazon has made a lot of big pledges over the past year. Last September, it came out with this climate pledge that basically said by 2040 they want to be climate neutral. And so one part of that for Amazon in particular is making sure that the delivery vans they use are not emitting carbon, so that they aren't, traditional combustion engines. Last year, they placed an order for 100,000 electric vans to be delivered over the next decade. This order today adds on top of that another 1,800 that are supposed to be delivered much quicker. So they are getting closer. There are still other aspects of their corporate structure that have to be quote unquote green. So they still have a lot of data centers. They still have other parts of the business that are not climate neutral at this point. But it's certainly a step for Amazon, but it will take many years. These vans aren't supposed to be in circulation. They won't really replace all of the traditional non-electric vans or vehicles that Amazon has until 2030. So still a long way off.
Absolutely, Chelsea. Thank you, and do have a great weekend. Well, let's head over to London now, where the aviation sector is still reeling from the coronavirus pandemic, with airlines posting losses and announcing job cuts. Juliana Olayinka is standing by in our London studio to tell us more about this. Good afternoon, Juliana. Gatwick Airport has released its first half yearly results, showing a 61.3% decline in revenue, while earnings before tax and interest plummeted by 98.3%. Can you tell us more about the results?
Well, I think the results speak for themselves, don't they, Bissy? And as you were saying, the aviation sector has been completely crushed by the pandemic. Earlier this year, Gatwick, which is Britain's second largest airport, did announce that there'll be about 600 job cuts after these 6-month results. We're expecting those job cuts to rise to about 1,000. Gatwick have tried to mitigate against these circumstances earlier in the year. I believe in about March time, they got a government loan, a coronavirus loan of up to £320 million, and they did put up to 75% of their staff on the government's furlough scheme, but it just hasn't helped. Their passenger numbers have plunged by about 98%. And then, of course, we got this update, this trade update for them. And what they did say is that they don't expect this to go to pre-levels for another 5 years. So they are in a lot of trouble. It's not just them. Of course, earlier this week, the Virgin Atlantic boss, Richard Branson, managed to secure a £1.2 billion loan. But that was after really being on the edge of administration. And British Airways said that they are getting rid of about 12,000 jobs. So the pandemic has really crushed the aviation sector. Gatwick at the moment are only running flights out of their North terminal, and they're really hoping and pleading that they'll be able to get out of this mess as soon as possible.
Well, then, Juliana, UK lawmakers and trade union Unite are asking for the government's job retention scheme to be extended to next March for the aviation sector. But with the UK in a recession, does the government actually have the resources to continue the scheme?
Well, that's a good question, and the answer will depend on who you ask. It's the government. It's not really the government that have been paying for this. It's the taxpayer that have been paying for this. And I suppose if you're a G5 nation, you definitely have some amount in your coffers to pay for more. A lot of the opposition critics are saying that Britain should really take the lead or follow the lead from Germany and extend the furlough scheme until 2021. But I think the government have been absolutely clear about this, that they don't plan on doing that. Chancellor Rishi Sunak has been barraged by journalists day in and day out whether they will or won't. He's made it clear on the record that the furlough scheme will not be extended. It will be coming to an end in October. Of course, initially, it was supposed to end at the end of June. It was extended by another 3 months, albeit at a lower rate of up to 60%. And those thoughts have been, echoed by the Bank of England Governor, Andrew Bailey, who, by the way, he'll be giving a speech at the Jackson Symposium at the top of the hour. But it's not been cheap. It's been very expensive. 9.1 million people have benefited from the scheme. About 1.67 million companies have taken it up. And it's cost the government at the moment about £31 billion. At the end of October, the Office for Budget Responsibility says that will rise to about 52 billion. Now, what the government is saying should be enough for those who are calling and crying for it to be extended is the job retention bonus scheme. So for every employee that a company takes back, they'll receive a £1,000 bonus. A lot of big companies like Primark have rejected this amount, saying that they don't need it. And the Labour Party is saying rather than offering this job retention bonus scheme, what you should be doing is looking at this in more of a holistic approach and offering some smaller companies or some sections of the society the opportunity to extend it. But in short, I would say the answer is no. And I think the government and the Bank of England have put that on the record quite a few times already.
All right, just before you go, Juliana, tell us, are the markets still reacting to Prime Minister Abe's resignation, and what is your outlook for next week?
It was a shock for us all this morning when the long-serving Premier decided to step down on health reasons. I think the Nikkei 250, the local Japanese Nikkei, that fell sharply at about 1.5%. Been a pretty damp start and end. Apologies, to the FTSE here in London. The all share is down 0.19%. The FTSE 100 is down also by 0.19%. And the FTSE 250 is up by 0.04%. In currencies, pound is up on the US dollar by 0.55%, down on the euro by 0.03%, and down on the Japanese yen by 0.26%. It's worth mentioning, even though last week we did see the Japanese economy in Q2 contract by 7.8%. If you compare that to here in Britain, we contracted by 20.4% here in the UK. So even though Japan was technically in a recession before COVID came about, Abenomics has really stirred Japan into being the third largest economy in the world. Even some economists are saying that the recovery for Japan will be a much shorter term, just because it is a war-like economy. And of course, in the region, particularly in Asia, a lot of investors and traders, they do run to the Japanese yen as a safe haven. So I did hear you speaking to Chelsea in Frankfurt earlier, and I do agree with her that whoever does succeed him, they are likely to continue with his Abenomics policy, which has, lifted up so many people out of poverty in Japan. But I've got to say, his departure will be felt more geopolitically than economically. And of course, there have been well wishes from across the world.
Thank you, Juliana. Do have a great weekend.
Thank you.
And stocks in Asia Pacific's major markets were mixed on Friday as investors reacted to recent developments from the U.S. Federal Reserve. The shares in Japan fell. The Nikkei 225 closed 1.41% lower, while the Topix index shed 0.68%, ending its trading day at 1,604.87. The Japanese yen changed hands at 106.06 per dollar following reports that Prime Minister Shinzo Abe plans to step down to deal with a health problem. Mainland Chinese stocks led gains among the region's major markets, and the Shanghai Composite was up 1.6%, while the Shenzhen Component gained 2.33%. In Hong Kong, the Hang Seng Index advanced about 0.9% as at its final hour of trading, and South Korea's Kospi gained 0.4%. We'll take a look at the financial fraud schemes in Kenya when we return in just a moment. Please stay with us. Welcome back. South Africa's National Treasury says there are no additional resources available for government departments in the next 3 years. The acting head of the Budget Office explains that any additional allocations will have to be funded from reductions in other programs, either within the department's budget or from another department's budget. The Treasury said in a supplementary budget presented in June that it planned to raise an additional 40 billion rand in revenue over the next 4 years. The document presented this week shows that it will be made up by 5 billion rand in 2021 to 2022, 10 billion rand in 2022 to 2023, and in 2023 to 2024, and 15 billion rand in 2024 to 2025. Africa's second biggest oil exporter, Angola, has unveiled a 2020 to 2025 energy roadmap which foresees oil discoveries of up to 57 billion barrels of crude oil and 27 trillion cubic feet of gas. The plans involve $679 million in foreign investment and $188 million by the Angolan state as part of an effort to reverse years of declining oil output and boost revenue for an economic reform drive. Angola's proven oil reserves currently stand at just 7 billion barrels, and that's according to the new Hydrocarbon Exploration Strategy report. Financial abuse, graft and fraud have long plagued Kenya, hampering development, exacerbating inequality and suppressing economic potential. Last week, the Central Bank of Kenya warned against foreign exchange scams, saying that brokers have been targeting Kenyans via social media and mass emails. Joining me now to talk more about financial fraud scams and its effects in Kenya is George Bodo, who's a director at Call Street Research and Analytics. Good afternoon, Mr. Bodo. Thanks for joining us on the program. So this week, financial regulators warned citizens of the reemergence of fraudulent and unlicensed financial schemes seeking to take advantage of Kenyans during this period of the COVID-19 pandemic. Tell us, how rampant have these schemes become and how it's affecting investor confidence?
Yeah, good afternoon. These things have been very rampant in Kenya for quite a number of years. We do call them. The official name is pyramid scheme. They take money from the public and promise very supernormal returns within short periods of time. And of course, ordinary Kenyans being very gullible and the promise of return to their eyes, they fall for a number of these stories. There's been a number of efforts by the government to stamp out these practices, but so far unsuccessful. One of the biggest official inquiry into these programs was done about 10 years ago. There was a multi-sectoral, a multi-ministerial committee that was set up to investigate how prevalent these things were. And they discovered that Kenyans had lost about $1 billion for the period between 2004 and 2008. Kenyans had lost about $1 billion. And this is just the principle, excluding interest being promised. And most of the schemes it promised ordinary folks that, look, they came in the form of circles or investment groups, collecting money from a number of people, telling them, after 1 week, after 1 month, we'll give you X amount of returns. But they never actually disclose how they're making that money. They just promise returns to Kenyans. Over the years, over the decades, they've metamorphosized, and now the most common one is through real estate schemes where they basically sell you a piece of land, or they sell you a housing development. That is not going to take off. They tell you within 3 years this thing is going to be up. They just show you drawings. So the most common right now we're seeing is in the form of real estate.
Well, are there any systems that have been put in place by financial regulators to help citizens actually verify the authenticity of a financial service?
There is no much, on the formal side, there is no much that has been done to help the citizens to screen or peruse these individuals or these groups that are masquerading or fronting themselves as legitimate, which is why the authorities regularly they keep issuing these caveats that advising citizens that be wary, be careful, please deal with licensed entities. One of the most regular name in issuing these caveats is the Capital Markets Authority. And over the last 5 years, we have seen emergence of a number of platforms, especially forex trading platforms, that are promising humongous returns over a short period of time. They're just inviting people, say, come trade with us, like X amount of money in a short period of time. And even now, over the last 2 years, a number of them have been fronting themselves as in the form of Bitcoin, telling people, there's so much gold you can achieve mining Bitcoin. So that's why authorities like Capital Markets Authority have come forward a number of times, actually, by the way, to warn the public and say, look, only deal with licensed people. If you are doubting the authenticity of the entity you're dealing with, please cross-check, and then they also give a list of license or institutions that they should deal with. It's a big issue for this public regulatory institutions, especially Capital Markets Authority and the Central Bank of Kenya and even the Insurance Regulatory Authority, because over time these things dent confidence that ordinary citizens have on a number of institutions. They check out the confidence that you would have even in licensed institutions, because you can imagine if you lost your money in a scheme, you would actually be very, very, very worried to deal with it in a licensed institution. So it's a question of trying to restore confidence, which one you see about 3 days ago, all of them came up and said, look, you have to be careful.
In 30 seconds, could you tell us now, what would you say are the effects of financial fraud and liquidity on the financial performance of commercial banks in Kenya?
I think, for one, what I've just said, it's a key thing is that they dent confidence that the ordinary people have on public institutions and even licensed institutions, including mutual funds, unit trusts, and even licensed forex trading platforms. Confidence goes away, which is very critical because it operates on confidence. And the second issue is that the boss had a big concern for government.
All right, we'll just have to let it go at this point. We'd like to thank Mr. George Bodo, a director at Call Street Research and Analytics, for joining us on the program. But just before we go, Kenya Airways has reported a first-half pre-tax loss of 14.36 billion shillings as COVID-19 prompted months of suspended travel, slashing its revenue. The airline warns that full-year results will also be affected as air travel demand is expected to be less than half of that of 2019 for the rest of 2020. And that's our program today. Thank you for watching. I'm BC Adebayo.